In a lot of ways, it feels like we're walking along the edge of something. 2 years since the Bank of Canada started hiking interest rates, but before the central bank starts cutting them again. All of us waiting in limbo, asking the same questions. When the Bank of Canada started hiking interest rates in 2022, its goal was to get inflation under control without sending the economy careening into a ditch. Today, inflation's back below 3%, and so far at least, the economy's avoided a recession. Did the Bank of Canada accomplish the goals it had at the outset?
Yes, inflationary expectations are well anchored.
Right. That's Jim Thorne, an economist, investor, and outspoken critic of the Bank of Canada. And even he says the central bank did what it had to.
They had to raise rates. People were freaked.
And raise rates they did.
Inflation is too high. It is higher than we expected, and it's going to be elevated for longer than we previously thought.
As interest rates shot up, inflation began to decelerate. Households were squeezed, so they spent less.
We're trying to balance the risks of under and over tightening.
As supply and demand came back into balance, inflation worked its way back to the bank's target of 1 to 3%.
If the economy evolves broadly in line with the projection we published today, I expect future discussions will be about how long we maintain the policy rate at 5%.
But progress has been painful. Damage has been done. Unemployed people are lining up looking for jobs. The economy has barely grown at all since last April. People across the country are feeling squeezed, overwhelmed, and pessimistic about the future. They're not convinced the Bank of Canada is working to make their lives better. More than 2 million Canadians are set to renew their mortgage at much higher rates over the next 2 years. But Macklem won't say when they can expect to see a break.
It's premature to start discussing lowering interest rates, but as inflation comes down, yes, we will have that discussion.
That's small comfort to anyone lumbering under the weight of a variable rate mortgage, or someone who had their rent jacked up by a landlord trying to cover increased borrowing costs. But if you strip out shelter costs, largely driven by higher interest rates, inflation's already at or below the central bank's target. But economists say Macklem's still worried that inflation could re-accelerate.
If you start lowering too soon and inflation starts to pick back up, then again, you run this risk of inflation getting out of hand and then destabilizing those expectations.
But there's no question, pressure is ramping up. People want the bank to cut rates, and the risk of leaving rates this high is surging as well. Did the Bank of Canada make things worse or better?
They can make things worse if they don't reverse course right now.
Home sales have fallen, construction is down, and it generally takes about 18 months for interest rate changes to work their way into the economy. So the full impact of all those rate hikes hasn't hit the economy yet.
The question you're not asking.
Thorne says Canada is notoriously awash in debt. Governments, households, businesses, and even the banks, he says, are overexposed, and leaving rates too high for too long can have devastating consequences.
We're not going to miss this one. In fact, we're going to be ground zero. And the confidence that people have because of what happened in 2008 is totally misplaced,
Raising rates was easy. Navigating whatever comes next, that's the tricky part. Canada's economy stands on a razor's edge. On one side stands a soft landing and some kind of turnaround later this year. Wobble the other way, though, and there's a very real risk that things get worse, not better. And that is the risk facing the Bank of Canada right now.